Funds with more than $100 million must file disclosures about their holdings within 45 days of the end of each quarter. These provide a glimpse into the stocks of secretive money managers, including hedge funds and large family offices. In this video, we're covering the 10 stocks super investors bought most in the last quarter, starting with number 10, Adobe. Adobe is a longtime super investor favorite, with 10 of them owning the business and 5 buying in the most recent quarter. This is led by a 4.9% holding from Viking Global Investors and a recent 2.8% buy from the Hillman Value Fund. Right now, Adobe is a $236 billion company that's trading $75 below their 52-week high, though the company's trading more than $100 over its 52-week low. Its shares fell off a cliff going into the fall of 2022. Since then, it's more than doubled in price. In its history, Adobe's been a long-term compounder, really taking off in its share value since the global financial crisis. Right now, it looks like Adobe is on the high side of some of their valuations, although they're trading slightly below their median price-to-sales ratio in the past decade. Still, they're out ahead of their free cash flows. Adobe's been a strong performer, growing a ton in the last decade and posting pretty high returns on capital through most of these years. The company also has a net cash position on their balance sheet. Today, Guru Focus has a fair value for Adobe is around $584 per share. That's up slightly from their current stock price. Their cash flows don't quite support this valuation, saying Adobe might be overvalued by as much as 12%. Still, analysts are bullish on the company, targeting a 10% upside. Next on our list at number 9 is Humana. The company's stock price is down a ton in 2024. Humana is owned by 5 super investors, all of whom bought in the last quarter. The leading positions in Humana are owned by Chris Davis, who has 4.9% of his portfolio in the company, and Seth Klarman, who has 4.4% of his portfolio. Chris Davis is on the board of Berkshire Hathaway, and Warren Buffett said he would trust Seth Klarman to manage his own money. Right now, Humana is a $46.5 billion healthcare insurance company that's trading $50 above its 52-week low. This is down nearly $200 from their 52-week high. One thing about Humana is that they are a dividend growth stock. Though they pay just a 1% dividend yield and didn't grow this by that much in the last year, they have grown their dividends consistently for 7 years in a row. On top of this, they're buying back shares and have a 4% shareholder yield today. Humana's also performed well throughout its history, although they have had some shakier years, especially in 2020 recently. The company has added on some debt, but they're still earning high returns on capital. Right now, Humana looks potentially cheap compared to their projected free cash flows and where they've traded in the past. Guru Focus has a fair value for Humana at $620 per share. That's up more than $260 from their current stock price. Looking at their free cash flows after their misses in recent quarters, it looks like the company's closer to a fair value with just a 4% downside. Analysts aren't quite sure what to think with a mix here, but an 11% upside overall. At number 8 on our list, we have Solventum, the 3M healthcare spinoff. Solventum's also owned by 5 super investors, all of whom bought it in the last quarter. This is led by Nelson Peltz, who has a 6.9% position in the company. Familiar names Seth Klarman and Chris Davis also bought into Solventum in the last quarter. Since they were buying, the stock traded even lower, bottoming at around $48 per share in the middle of July. Solventum is a $10 billion market cap that's now trading $12 above their 52-week low and $10 below their 52-week high. As a new company, there's less operating history for the business. Overall, though, they've been relatively stable in the last handful of years, but the company did add debt as they were leveraged and then paid a dividend back to 3M when they were spun off. All this combined, analysts have a $54.50 price target for Solventum, implying around a 9% downside. CVS Health is number 7 on our list. There are 9 super investors who own CVS. This is led by a 3.7% position from Hancock Classic Value. Chris Davis again shows up on this list with just a very small position. Samantha McLemore of Patient Capital Management and an apprentice to Bill Miller has a 2.3% position. Today, the $74 billion company trades just $4 above their 52-week high, and they're down more than $20 from their low. CVS has a long history of paying dividends but not necessarily growing them. Today, they offer a 4.65% dividend yield, which is way higher than the market average. On top of this, they bought back some shares and they've grown their dividend in the last year by nearly 10%. That's a very solid 6.8% shareholder yield right now. CVS has made major acquisitions in recent years to get their business more and more focused on all aspects of healthcare. They've acquired provider groups as well as their own pharmacy benefit management insurance company. The company's steadily grown sales, but they're seeing their profits come down in recent years. At the same time, their returns aren't quite as good as they were before some of these acquisitions when they added on a lot of debt and issued shares. CVS is still free cash flow positive, and they're trading well under their projected free cash flows and way under what they've traded for in the last decade. A GF value for the company comes in at $104 per share, which is nearly double their current stock price. Their ability to generate free cash flow could mean the company's undervalued by as much as 43%. Analysts are bullish on the business from today's prices, but not quite as much as their numbers support. They project a $71 price target with a 24% upside. At number 6, we have perhaps a lesser-known business in MSCI Inc. MSCI is owned by 8 super investors, and the company had a bunch of insider buys in late April and early May after their stock price cratered. Since then, this has rebounded sharply, and they're trading at $580 per share. Triple Front Partners and AKO Capital both have 3% of their portfolios invested in the company. MSCI is a $42 billion company that's trading $24 below their 52-week high. While it might not be a household name, the company has more than $1.4 trillion in assets in ETF and indexes. They also make a ton of money from their real estate, market data, and ESG analytics. They've been very steady in the past decade, increasing their sales and free cash flows. While they've also increased their debt, they still earn very nice returns on capital. As a cherry on top, they bought back a major amount of their shares in the last decade alone, trimming these from 120 down to 79 million shares outstanding today. With their recent rebound, MSCI looks like they're trading out ahead of where they have in the past decade. That was when they had market-beating performance. Still, a GF value comes in at $622 per share. That's up $40 from their current stock price. Analysts aren't as bullish, saying their stock is around fairly valued. MSCI is also a dividend growth stock, growing these 10 years in a row and by 15% in the last year alone. Now, before we get to the top 5, you can find even more fair values shared daily on our Patreon. These are absolutely free, and if you want to, you can also support the channel here. Check it out in the first link in the description below. Apple is the number 5 stock on our list, even as Warren Buffett cut his position by half. As Buffett was exiting, other super investors were piling in. This included Francis Chu and Daniel Loeb from Third Point. Apple needs no introduction, but even as Warren Buffett, its biggest shareholder, cut his stake by half, it's gone to all-time highs. Apple today is a $3.5 trillion business that trades just $8 below its all-time and 52-week high. Right now, Apple looks stretched compared to nearly all measures of its past valuations. This is why a GF value for the company only comes in at $182 per share, which is much closer to where Buffett was selling. Apple's about $40 overvalued based on this. A discounted cash flow analysis gives Apple around a 30% downside from today's prices. Analysts are on the other side of this though, targeting just a slight 3.5% upside with a $234 price for Apple. As the company's been more renowned for its buybacks in the last decade, they're also a dividend growth stock, growing their dividends for 12 years in a row. It's very likely Apple would be a dividend aristocrat and maybe even one day a dividend king in their future. Uber is the number 4 stock super investors were buying the most of. Right now, 10 super investors own Uber, and the top 6 holders all bought it in the last quarter. This is led by Thomas Russo, who has 2.8% of his portfolio in the business. The rideshare company is a $122 billion market cap today that trades just $10 below its 52-week high. Uber looks stretched beyond where it's traded even in its past compared to those multiples and what the future may look like. This is why a GF value comes in at $57 per share, down $14 from their current stock price. Uber's climbed higher in the last year as they posted by far their strongest ever year performance in terms of sales and free cash flows. Still, though, the company's continuing to grow and they're continuing to dilute shareholders by large amounts. Microsoft's the 3rd most bought stock in the quarter, and it's the 2nd most owned super investor stock overall. There are 9 super investors who have double-digit percentages of their portfolios in Microsoft. No surprise, this is led by the Bill and Melinda Gates Foundation Trust, which has 33% of their holdings in the company. Alta Rock Partners and Terry Smith follow behind with 18% and 13% of their holdings respectively. Microsoft's an old reliable that's one of the top performing stocks of all time. It spiked during the dot-com boom and was flat for more than the next decade, but since the global financial crisis, it's truly soared to new heights. The company's growth and profits have looked stellar in the last decade as they're continuing to sit on cash and earn high returns on capital. They bought back a lot of their shares over this time, but interestingly, in the last year, they're actually starting to dilute shareholders. This could mean the company views itself as being overvalued. Still, there's little doubt today that this is a great business, which is why its GF value comes in $5 above their current stock price. Microsoft again is an unlikely dividend growth stock, growing their dividends by more than 10% in the last year alone. This growth has continued for 19 years straight, and Microsoft's only 6 years away from becoming a dividend aristocrat. Today, Microsoft's a $3.1 trillion business that trades $57 below its 52-week high. That's still almost $100 above their 52-week low. Analysts still want to see the stock trade even higher, targeting $491 per share and a 20% upside. The second most bought stock, United Healthcare Group. 17 super investors own Humana today, and most of them were buying during this time. This is led by a 6.8% holding from David Ralph, and Sequoia Fund has 5.6% of their portfolio in the company. United Healthcare is the $515 billion healthcare insurance behemoth. It's trading at its 52-week highs, which are more than $150 above their 52-week lows. Unsurprisingly, like a lot of these companies on our list, it's another dividend growth stock. They've grown their dividends 14 years in a row and by 13% in the last year alone. They even buy back shares and have just under a 3% shareholder yield today. United Healthcare is especially one of the top performing stocks since the global financial crisis. They're up nearly 30 times in the last 16 years alone. The company's performance has been even steadier than peers, and they've trended upwards in nearly all of these years. This is why even as United Healthcare trades at its 52-week and all-time highs, it looks like a GF value says the company could go even farther with a $610 fair value. Analysts expect that the stock is around fairly priced, giving it just a marginal 3% upside. Now it's time for the big reveal. Are you ready? The number one stock that super investors were buying in the second quarter in 2024 was, drumroll please, Berkshire Hathaway. 19 super investors own Berkshire Hathaway B shares and 14 others own Berkshire Hathaway A shares. The B shares were getting the love this quarter, so that's where we'll focus. Guy Spear is the leader here with 22% of his portfolio invested in the company, followed closely by Bill and Melinda Gates. Chris Bloomstrand and Li Lu also have more than 17 and 14% of their portfolios invested in the business. Things on the A-share side are even more concentrated, with Norbert Liu of Punch Card Management having 63% of his portfolio in Berkshire shares. Francis Chu also has a 40% stake, and Chris Bloomstrand again has a 14% stake, raising that even higher in his holdings. Berkshire Hathaway is the old reliable that just recently, for the first time ever, hit a $1 trillion market cap. As it hit their new all-time highs, Warren Buffett has stopped buying back shares. He also has more than 25% of Berkshire's assets in cash, as he's been selling down major stakes in his stock portfolio. With those latest developments, Berkshire's trading out ahead of where it has in the past decade. It also looks like it may be too richly priced for Buffett himself, again as those buybacks have stopped amid a mounting and growing cash pile on their balance sheet. Let me know your thoughts on these latest super investor buys in the comments below. As always, thanks for watching the video.